Okay. The offer clearly the course. Hi, I'm Professor Ashok Patil and welcome to the Corporate Valuation third module. In the first two modules, we looked at what is the importance of time value of money and what are the drivers of value. Time value of money is required to calculate the present value of future cash flows. The second part, what drives the value, will decide where to focus on. Particularly, we saw that the value is derived from two factors. One is the return on invested capital, ROIC, and the second one is the growth of the free cash flows. We also saw in the previous session that not all companies can focus on the growth opportunities. The companies whose ROIC is greater than Wscc should focus on the growth opportunities. Those companies whose ROIC is less than Wscc should focus on increasing their ROIC before going or jumping into the opportunities created by growth prospects. The third case, which is hypothetical, when ROIC is exactly equal to Wscc, it doesn't matter whether the growth opportunities are taken or not because the value will not change. We have seen that, and we also saw that what value entails. The value entails the present value of future cash flows right? And we have seen the perpetuity case value of the operations can be calculated as FCF 1 Wscc minus G. We have calculated FCF. We have been given the growth opportunities and we have done the calculation for the value assuming that Wscc was given to you or known. Today we are going to look at how to calculate this Wscc in order to calculate the value of the firm. We have seen the relevance of all these factors in calculating the value of the firm. If you make the wrong estimates of free cash flows, obviously the value will change. Wscc, if you calculate it on the wrong assumptions or estimates are inappropriate, then we'll find that the value also is get affected. So these are very, very critical points when we are calculating this, because after calculating the value based on these parameters, you are going to take a decision on whether to buy a company or not, buy an asset or not. So this becomes very, very important for you to see that you actually check the assumptions behind all these calculations, free cash flow and WSCC. Today's focus is on WSCC component, and we are going to look at this WSCC, which is nothing but weighted average cost of capital. How this plays important role in this, because as the WSCC increases, we can see the value of the organization will go down, remaining assuming all other factors remaining constant. Now today we are going to see that how a WSCC is calculated. So first of all, what is cost of capital? Now we must have seen that in the previous courses, the cost of capital, basically we are talking about debt and equity. In order to generate the free cash flows, the company needs to employ certain assets, and in order to buy those assets, the company can generate the funds either by using the debt or equity. When they issue the debt, it's to the bondholders, and when they issue the shares, it is to the shareholders. So we can see that the weighted average cost of capital comes from different components, different parties, different stakeholders. We also have something called the preferred equity, and these are the three things which we'll be looking at in detail, and how actually the cost of capital is calculated, and what are the assumptions and how to deal with all those assumptions. So cost of capital actually is having three components: debt, preferred equity, and common equity. When we see that we need the capital normally it can be short-term debt and long-term debt. The long-term debt is actually considered as under the debt, preferred stock, and lastly the common equity. You can say that capital components are the basic sources of funds which are used, although there are working capitals which are used to operate the daily activities. Those are not considered as capital. So what is the definition of capital? The capital is that component of the funding which comes from the investors. If it is not coming from the investors, then it is not classified as capital. So for example, when the money from the account payable, when we raise the loan from the local seller or local buyer, then that amount is not calculated as capital, because that person is not investing that amount of money in the company as an investment. So that means the money which is there, which is used for the daily operations of the company, is not a capital. Capital is basically for a long-term purpose, but we can see that the equity, which is shares, is having a long-term purpose, and therefore equity is definitely a cost of capital. You can see that accounts payable, accruals, deferred taxes are not sources of funding that come from the investors. So they are not included in the cost of capital. Now the next thing comes is that when we look at the Wscc, whether we should take the cost of debt, the interest rate charged on the debt, should be taken post-tax or pre-tax. Now one can definitely do both, but it is important that the cash flows are considered at only one time. That means if we are calculating the cash flows on the pre-tax basis, then the Wscc which is to be calculated will be without a taxation. But when we calculate the free cash flow post tax, after tax, then already we have punished the free cash flows for the tax, and therefore we should also reduce Wscc by that much amount, and therefore in that case Wscc will be deducted. So let me write that equation. So what happens is FCF is nothing but EBIT into 1 minus T minus net investment in operating capital divided by, now Wscc can be calculated as the weighted average. Now we can also see that weight of equity, cost of equity, that is RE, plus weight of debt. Now is the change 1 minus tax. So post tax cost of debt, RD, plus weight of preference shares and cost of preference shares, minus G. So you can see that the weighted average cost of capital is calculated on the after tax basis. Now how do we calculate the cost of debt? The cost of debt, there are different ways to calculate. You can actually see that the coupon rate, what is the coupon rate on the new rate which will be charged if the company goes for the loan. And you can see that what is the investment banker is offering the rate for this, and that rate can be taken as the cost of debt. The second method, the bond rating for the company, and use the yield on those bonds with the similar rating. Now this becomes a little bit difficult because you have to see that what are the similar type of companies and whose bond are trading in the market. The method 3 is find the yield on the company's debt and use that as the cost of debt. Now we've seen that there are 3 methods and each method has its own drawbacks, but normally we can see that the first one, which is not efficient, because when we calculate the investment banker's rate, coupon rate, that is the judgment of the investment banker to offer the rate which may be fixed for a particular time period. But when we are talking about the cost of the debt for the entire companies, we have to see that what are the classification of the debt that the company is having, and each debt has a different maturity period, and therefore we need to see that how the weighted average of those debts itself is considered before we actually apply it. So we have to see whether this method can be applied in practice. So it's better to go ahead with finding the yield on the company's debt, and then you can actually use that. Now suppose you want to find the yield on a particular bond which the company has issued, and you can see it here. If there is a 15-year bond which is issued by the company with a 12% coupon rate which is paid semi-annually, and present price of the bond is 1153.72, what is the yield on this particular bond? Now you can use the calculator, or you can use the formulas which we studied in the first module, using time value of money, and then you can calculate. Here in this example it is 10%. So you know that the yield on the bond which the company is issued for 15 years maturity, 12% coupon rate, paid semi-annually, is worth carrying the cost of 10%. Now you want to use this particular cost as the beginning, and then as we have seen in the formula that we would like to use the cost of the capital, cost of the debt at the after tax basis. So to calculate the after tax basis, you can see that the tax component of the RD is deducted. So you can see that RD before tax in the bracket 1 minus tax, the tax rate being 40%, we see that cost of debt is 6%, right? Now one can see it here, although the loan which is raised at 10%, the entire 10% is not considered to discount the cash flows. So what is used is the cost of debt minus into 1 minus T. That means because of the debt, you can get a tax rebate on the earnings of the company. Since you have raised a debt, you will get a tax rebate, and that tax rebate is actually considered in this formula. If the flotation costs are there, that means the cost which is involved in floating the bonds, the charges are various charges when the bonds are the payments of the fees to the underwriter and all those things which are considered, then the only factor which changes is that you calculate the value minus the flotation cost, and the other part remains the same, which is the valuation of the bond. So this formula can be used, and then after this again you can take the post-tax cost of debt. So for example, now we can go ahead with the next one, that is the preferred stock. Now preferred stock, the formula is this, that is RPS, preferred stock, the return on the preferred stock, that the cost of the preferred stock is the dividend paid in the perpetuity case, right, divided by the price of the preferred share minus flotation cost, if any. And using this example, you can see that 10% is the quarterly payment which is made on the face value of 100. So that comes out to be $10 as my dividend paid. And you can calculate the denominator by just using this formula, Pn, that is the price of the preferred stock, present price, which is nothing but 130.10, and the flotation cost of $2. And you can see that the cost of preferred stock is 9%. So we calculated the cost of debt and now calculate the cost of preferred stock. Now this is how it looks. If you see that if the 2.5 is paid for a given period, infinity, and the present price is 111.1, then using the perpetuity formula, which is nothing but dividend which is given in perpetuity, which is 2.5, divided by the cost of this. And if you just mathematical adjustments are done, you can see that the R per period is nothing but 2.25%. And since it is given quarterly, I can see it here, it is given quarterly. So we can see that the rate is 9%. So using this formula, the logic behind this can also be explained with the time value of money, and you can see that the cost of preferred is 9%. Is preferred stock more or less risky to investors than debt? Now, one can see that the preferred stocks are more risky because if the firms want to pay preferred dividend, they must pay it before they pay the common dividend. So it is important that it is paid before the common dividend. Difficult to raise the additional funds, and in case the preferred stockholders have more share or percentage of stake holding in the company, they would like to take the control of the firm. So that means it is a very risky proposition for a company, and therefore it is preferred stocks are more risky. According to rules that only the 70% of the preferred dividends are non-taxable and the remaining is taxed. So one can actually calculate the other way around of calculating the preferred stake. In case the law changes, we should also change the taxes accordingly. And then if only the 70% of the preferred share are taxed, then you can see that this is the cost of post-tax cost is 7.92, and whereas the cost of debt post-tax is 6%. So even though we see that from the interest perspective, the cost of debt is 6%, whereas the cost of preferred share is 7.92. So that means it is riskier than the debt. Now the next point is that we have seen the next date, how the dates are issued to raise the funds, and also see that the preferred stock and preferred stock being more risky. The third point is that now the equity. Now we see that the equity is issued in the beginning and the company receives the funds, and that fund, those funds are used to buy the assets and then in turn generate the free cash flows for the company. Now at the end of the year, when the free cash flows are generated, the company has two options. One is that actually pay the free cash flow generated back to the investors in terms of dividends. So all the free cash flows are given back to the shareholders, and shareholders can actually invest wherever they wish to. They will bear the risk of the cash flows which are there. That is the first. So that means they have to again issue the shares to get the new funds. But then other option is that instead of paying the dividends to the shareholders, part of that can be reinvested in the company. That means we are not paying the entire profit of the company which is generated for a particular year back to the shareholders, but that amount is kept with the company itself and that is reinvested. It's indirect generation of the equity. So same amount, instead of paying back, we can continue using that particular amount for the future purpose. Now these are the two ways. So that part which is not paid as the dividend is called retained earnings. And as I said that if the dividends, instead of dividends, the entire money is given back to them, they can actually invest that money in some other opportunities there, and therefore it is also called the opportunity cost. The cost of equity is generally denoted by RE or RS. And there are three methods by which we determine the cost of equity. So as we have seen in the previous year in the security analysis and portfolio management, the CAPM, capital asset pricing model, is the first method where we can calculate the cost of equity. The second method, which is the dividend discount method, which we can be calculated like this. And then the last one, which is the bond yield of the same company, and then add the bond premium to that particular component, and then you will get this. So what we can see it here is that when the CAPM is used, the cost of equity is nothing but the basic risk-free return which an investor will get from outside the company. It may be treasury bill, as we have seen in the previous courses, plus the market risk of the company, the B part, the market risk of a particular company, into RM minus RF, that is the risk premium in the market. So for investing in that particular company, how much you are actually getting more risk. This component B into RM minus RF denotes that, plus minimum return which you should get. So risk premium multiplied by the beta of the company plus risk-free rate gives you the cost of equity. And we have seen that in the previous courses. We also see one or two examples over here. Second one, we can see that the Dcf method is used to calculate this. Now we can actually see that we can write it once again, but we have seen that, and the derivation is very simple in this case. We assume that company is a going concern. If company is a going concern, and we would like to calculate the value of the firm, and if it gives the dividends, same dividends in perpetuity, it's a perpetuity case, and we are actually going to see this, and the growth is, let's say, 1 plus G, 1 plus G, 0 into 1 plus G square, like that, and there is a constant growth is not changing, and then you can see that this formula can be used, and this is Dn, then you can see that, and it goes into perpetuity, and this is the price today. Using the annuity, perpetuity, sorry, you can see that this formula reduces to D1 divided by R minus G. So the P0 is D1 upon R minus G. So you can also write this like this, that is R minus G is equal to D1 upon P0, and therefore R is equal to D1 upon P0 plus G, and that is the formula which we see in the on the board. So we have seen that the discounted cash flow method here is derived from the dividend discount model, and if the flotation costs are given, you can just see that the P0 is adjusted with the flotation cost. And the last method, which is own bond yield plus risk premium, which is the cost of debt of the company plus the bond risk premium. How much is the risk premium the bond is being paid will inform us about the company's performance, and that, if added to the cost of debt, should give you the cost of equity. That is the third method. Now, as a simple example, just for the illustration purpose, if RF risk-free rate is 7%, risk premium is 6%, that risk premium is nothing but RM minus RF, and the beta of the company is 1.2, and just plugging in, you can see that the cost of equity is 14.2%. If you use the dividend discount model, DCF method, and apply this equation, then you can see that using the 5% growth here and P0 being 50 and dividend at in the beginning is 4.19 and therefore 1.05 is the growth rate on the dividend and we get the answer of 13.8%. So you have seen that the cost of equity using the CFM model is 14.2%, whereas using the DCF method is 13.8%. So there is a difference in the cost of equity when it is calculated using two different formulas. So in case the growth is not given, then probably you can use this equation to calculate the growth. Return on earnings of the company multiplied by the retention rate. So retention rate is the amount which is retained by the company from its cash flows and the return generated on those cash flows. And obviously that should be the growth of the company, and that's how one can calculate what is the retention growth of the company. So if you retain the cash flows of the company instead of paying it to the shareholders, that can be reinvested. This amount can be reinvested at a rate of return on equity of the company, and therefore that should give you the growth of the company. Now the last part, which is the third method, own bond yield, which is 10% given here, and the risk premium is 4%. So this comes to be 14%. We can see that all these estimates which are given and calculating this risk premium on the bond, we will be seeing only in the money and bond market course. But then you can see that the risk premium is calculated to be 4%, and then you see that there are three different estimates of the same parameter, that is cost of equity. So we got three estimates from three different methods, and you can see that CFM is given 14.2, DCF is given 13.8, and the bond plus risk premium has given you 14%. So usually one can go for weighted average, but also can simply go for the average, because we don't prefer one method over another. So you can simply go with the simple average and calculate the 14% as the cost of equity, and we can go ahead with that kind of estimate. Now we have seen these composition of the cost of capital, particularly equity, debt and preferred shares, and how to calculate them. We have also seen that what are the drawbacks of those and the assumptions underneath. Each method has its own assumptions. For example, CAPM had its own assumption of assuming the RF, risk-free rate, and also calculation of beta, which keeps on changing over the period depending on the performance of the company. That also is a variable. But we are using those, and we are aware of those limitations in calculating those factors. But in the formula of the Wscc, which I'll repeat here, we have seen only the cost of debt, but we have not seen the weights of the components. So we can see it here, Wscc, weighted average cost of capital, is weight of equity multiplied by cost of equity plus weight of debt into cost of debt, which is obviously post-tax, and plus weight of preferred shares multiplied by cost of preferred shares. Now this is the point which we are, and so far we have seen how to calculate KE, how to calculate KD, and how to calculate KPS, but we have not seen how to calculate the weights of these. Now once we put the weights, then we should be able to calculate the weighted average cost of capital. Not weighted comes easy, but then how does one decide the weights? The first and most important rule is that you should get the weights from the market values, not from the book values. As far as possible, you should go for the market. So for example, you can calculate the weight of the equity from the market price multiplied by the number of shares which are trading, and then you can see that what is the weight of equity from that amount. We will be taking one example.